So if your share is $20, you pay in $20, they give you 19 cents back. So that's how you would calculate your payments that you make, or the payments that you're receiving when you invest. You just simply take your amount of shares that you're buying, and then you times it by whatever the dividend is. Now there's 3 different types of dividends that I've seen. There might be more out there, but these are the ones that I stick with because these are the ones that I'm interested in. Again, it's your circle of interest or your circle of competence. There's the first dividend is REIT, which is a real estate investment trust. Now, if you're trying to get in real estate, let's say you don't have enough money to buy physical property, but you want to invest in maybe a company that is already doing that, you can most certainly do that. The cool thing about them, when it comes to taxes, is that 90% of the income that is made off these REITs is distributed to the shareholders. So, regardless, 90% of their income is regulated and has to be sent out to the shareholders first. All right, so that's a good thing for you because you're getting your money's worth when it comes to investing with them. They're not going to hold out on you, and that can be a problem sometimes with dividends. Sometimes people will go ahead and just completely cut a dividend out. All right, and then you're stuck without the dividend, and you got to hope that they're going to bring the dividend back in to play. So with REITs though, if they have a dividend, 90% of the income that they make has to go out to the shareholder, which is a very good thing for you. Now, as far as taxes on those though, there's still capital gains tax, which would fall under regular income. So it's going to be a max capital gains of 35%. Then you have MLPs, and those are master limited partnerships. And master limited partnerships would be like your industry sector, like your oil, natural gas, utilities companies. These are normally, when it comes to like the oil and natural gas, MLPs, there's a good majority of them that are very high risk, and here's why. Because a lot of them are doing exploration, so they're looking for oil, new oil, and new natural gas. So they'll have like a $200 million project, and they'll go ahead and go out and explore. Sometimes they may not, they might not strike oil, so they're out $200 million. The company might go under, and now you've invested and lost a bunch of money on an exploration company. So there's some risk there that you want to watch out for. The ones that I go with though are pretty solid companies for the most part. I'm interested in oil trusts because there's oil royalty trusts that are out there as well, and basically what those are, they're set up by a company that already has oil reserves and fields, where oil wells are already in production. They also are developing oil wells in multiple fields outside their already producing oil fields. So a royalty trust though would basically take a portion of the profits that are made from the oil production that is created from the company. And they're also kind of a good thing for companies who are trying to start new projects, because they'll create this royalty trust and it'll go out for a certain amount of time, like 10, 15 years, 20 years, and it helps raise money or raise capital for some of the projects that they're doing for development. And then what they do is they pay into the trust and pay their shareholders back with the already producing oil fields that they have in play. Now, the reason why I like them so much when it comes to the energy sector and like natural gas and oil is because they're tax deferred. or a portion of them is tax deferred. And what I mean by that is the government has mandated that only a portion of the income that you make off of MLPs is going to be taxed. Here's what I mean by that. So if you have, let's say you have a $10,000 investment, right? You throw it into an oil company and it's an MLP. Right off the bat, the government is stating that about 15 to 20% of the income, I can't remember the exact number, but it's between 15 and 20%. I think it changed to 20 just recently. But 15 to 20% of that income that you make off of your $10,000 investment is automatically tax deferred. All right. Now the oil companies will they'll manage the accounting behind that. So there's some shares, you know, that you might buy that don't fall into the tax deferment. So that portion of it, you're probably not going to have much control over. But just know that about 20% of the income that you make off of your $10,000 investment is going to be tax deferred. So in other words, like if you made $1,000 for the year on a $10,000 investment, you can automatically, and I'm not going to say assume because it's federally regulated, they have to, but you're looking at 20% of that $1,000 is tax deferred, so you're only going to pay on $800. Alright, now if you're wanting to know details on like which part of how many of your shares are actually in this tax deferment category, you're probably going to have to, you know, call the accounting department and just start asking questions, because I've never done that before. I really don't care. As long as I get my money and I know that I can shelter it, then I'm okay. Let's go ahead and talk about the regular stocks real quick, because I did mention that regular stocks do have dividends. Those would be companies like Walmart, Target, Verizon, you know, and a lot of them, McDonald's, a lot of them will pay like really, really good dividends if they're, you know, stable companies that have withstood, you know, the test of time. And I think those are really good stocks to get involved with, or companies to get involved with, are the ones that have withstood the test of time. So if you're looking at long term, those would be good stocks to look at. But again, the taxes on them are a max 35%. Then you have commodities. Commodities would be, you know, things like gold, silver, precious metals. I'll touch on these here in a little bit, but ETFs, we'll start with those, which is exchange traded funds. These are actually, a lot of times they're like a form of insurance, because what they'll do is they, not all of them, but there's a good pool of them that I'm involved with that measure volatility. If you're asking what volatility is right now, let me go ahead and explain that to you. Volatility would be the equivalent of, you've heard probably, Warren Buffett has quoted several times in speeches that he's made. He'll talk about be fearful when other people are greedy, and be greedy when other people are fearful, right? Well, volatility kind of plays into that. And what it does is it measures the fear and greed within the markets, like S&P 500, NASDAQ, Dow, and whenever you've some of them play like they'll go along with the stock market, and then some of them are inverse to the stock market, so they'll do the exact opposite of what the stock markets are doing. So basically what they do is they just go up and down. They measure the volatility of the markets. So if you have S&P 500 going up, and you have a ETF that measures volatility, and it measures, let's say, the fear in the markets, your S&P 500 is going up, that means there's no fear. So guess what? If it's inverse, like I was talking about, to the S&P 500, then the price of that ETF fund is going to go down. And normally what's included with these exchange traded funds, they're funds. So what's included in them would be normally like options. Okay, so if you're not familiar with what an option is, an option would be like, let's say there's puts and calls. Okay, a put would be you're betting that it's going to go down in price. And then a call would be betting that it's going to go up in price. Okay, so that's basically what options are. I'm going to go in on the options market, I'm going to name a put on this stock, and it's going to go down. In 3 months, it's going to be this price, and you make a bet that it's going to go down to that price. Okay, a call would be the same thing, it's just going up. So that's what options are, but there's funds out there in ETFs that hold options, and they'll be like, they're called futures, basically. But yeah, they measure volatility in the markets as well. And you can make a lot of money off of these. A lot of six-figure investors will use these. Now, there is some stuff that you have to watch out for, like backwardation and contango. I'm not going to get into those today. I'll go into those at a later date when we can cover ETFs in more detail. But the taxes on them are what they call a 60-40 rule. So you got 60% of your income that you make on those is going to be capital gains long term. So in other words, it's long term capital gains, which would be taxed at, I believe, 20% now. It was 15, but I think they upped that to 20 just recently as well. So 60% of the income that you make is going to be taxed at 20%, and then 40% of the income that you make will be taxed at a capital gains short term, which normally is 19%. And they said when you read the taxation on these, it says it's a blended 27% max. So in other words, let's say you make $150,000 or $200,000 on just short-term day trading with ETFs. Your max that you're going to be taxed is going to be 27%, and that's it. That's pretty good. I mean, considering that the max capital gains is 35%, you're already beating that by what, 8% almost? Yeah, about 8%. So that's pretty good. You get an 8% tax break just for using these. ETNs would be exchange traded notes. I'm going to go ahead and wrap this up here fairly quick because it's taking forever. And there's a lot to these, so I'm going to break them down one by one in later videos and go over them in better detail for you. But ETNs are exchange traded notes. These are taxed at a max of 35% on capital gains. There's the difference between these two is basically liquidity, or cash that is available from banks and institutions to go ahead and fund these two different entities when it comes to trading. So I'll talk about those a little bit more in detail later with liquidity and different things you can watch for on those. Then you have gold, silver, and precious metals, right? Well, a lot of people always want to talk about gold and silver. Here's the thing with gold and silver, guys. I'm not against it. I actually invest in it myself. You probably want to, if you have a portfolio, they say to usually make sure that you have gold and silver making up about 10% of your portfolio. So I'd only invest about 10% of whatever you have available to invest in gold and silver. That's normally kind of a golden rule there. But with gold and silver, you've got ETFs, like I was just talking about, that deal with the different companies out there that are exploring for gold and silver. You can use those, but again, that's outside my circle of competence. I like to stick with companies that produce something. Because here's the thing, gold and silver, it doesn't produce anything. Okay, it's only worth